I think the first thing would be whether there's any dissent. The last Bank of England meeting, there was a 6-3 split in terms of no change. So there was a dovish tilt to it. Catherine Mann, I think, could be the outlier in terms of going for no change in rates. But I think the risks around the labour market are clearly skewed to the downside. And whilst the near-term risks to inflation, I think, clearly are on the upside, reflecting national insurance contributions and also European energy prices, I think that the focus really has to be the extent to which the bank wants to deliver some credible forward guidance to the market and look through what will be quite a significant run-up in inflation in the months ahead.
How can the hawks justify pausing now if we do see one dissenter calling for a hold, given you've got growth down, you've got services inflation down, you've got labor market intentions down? What is the justification for pausing?
I'm not sure there is. The Fed is restrictive with rates at 4.375. The Bank of England is obviously very restrictive with rates at 4.75. There's clearly concerns about the supply side, crowding out because of fiscal stimulus, issues around the increased costs coming through in the labour market. But I don't see on a 2-year view there's any meaningful reason why the Bank of England can't deliver certainly solid forward guidance that rates could fall towards the 4% to 3.75 in the year ahead, with arguably risk to the downside.
What could that forward guidance look like if we do see them give us some kind of guidance? What would it look like?
I think it has to be risks around the labour market and also risks around demand. Remember that the OBR is currently a significant outlier in terms of expecting growth to be 2% this year and 1.7% flatlining thereafter. Even if trend growth is 1.25 to 1.5, over the medium term there has to be downside risk to growth. And with the limited amount of fiscal wiggle room that the Chancellor has, I think monetary policy activism will have to be a way of ensuring that we don't have a much more challenged economic cycle going into 2026.
At the moment, the MPC is looking at quarterly rate cuts. Could we see that change and actually see the MPC move to cutting rates at every meeting?
Not yet. I think the bank's going to be a bit cautious near term. I think as we get through this year, we could see slightly more rapid rate cuts, certainly down towards the terminal rate of 3.5%, but that would be some way into next year.
Mm-hmm. And what about the inflation target of around 2%? Do you think that that's still valid? Is that the right level? Is there any chance that the Bank of England adjusts it?
It's a great question. I think if central banks in the round were to sit down today and think about what an appropriate inflation target was, I think they'd probably say 2.5% to 3%. But I think the sharp run-up in inflation that we've seen in 2022 was a big knock to the credibility of central banks. So it's not something they can sell to the market. But more broadly, the Fed in particular, like the Bank of England, probably has a dual reality. It's talking about an inflation mandate that it doesn't really want to deliver against, but it doesn't want to lose credibility as well. So, as a fixed income person as well as a multi-asset person, I'm happy with 2.5% inflation. I think it does stave off the risk of hitting 2 but then ending up undershooting and then getting out of what is a very difficult deflationary hole.